Silver just outperformed gold by 200% this year, and I'm about to show you exactly why this happened and what it means for your portfolio right now. Look at this chart. While gold climbed an impressive 60%, silver exploded 103%. That's double the gains, and there's a specific mathematical reason behind it. The gold-silver ratio just hit 67 to 1. What does that mean? For every ounce of gold at $4,297, you can buy 67 ounces of silver at $64.25. Here's why that matters. Watch what happens when I overlay the Fed's rate cut projections. Every time the Fed signals dovish policy, this ratio compresses. That's your signal. When gold moves $1, silver historically moves proportionally more because of its lower price point and dual role as both precious metal and industrial commodity. But here's where it gets interesting. Open up any silver ETF like SLV right now and you'll see something unusual. Physical delivery stress in London is creating what traders call a supply squeeze. Let me show you the actual data. Solar panel manufacturers consumed 140 million ounces of silver this year. Electric vehicles added another 88 million ounces. That's industrial demand you can't replace with gold. Gold sits in vaults, silver gets consumed. Now the Fed just projected rate cuts extending into 2027. Here's your portfolio math. If you allocated $10,000 evenly between gold and silver on January 1st, your gold position would be worth $18,000 today. Your silver position, $20,300. That's a $2,300 difference from the exact same market conditions, and I'm going to break down why silver's industrial multiplier effect creates this gap. The weakening dollar adds another layer. Check this out. When the dollar index drops 1 point, gold typically gains $20 per ounce. Silver gains $1.20. Sounds smaller until you calculate percentages. That's actually a larger relative move because silver's base price is 67 times lower. You're getting leveraged exposure to the same macroeconomic forces. ETF flows confirm this. Silver ETFs added $342 million in new positions last month, while gold ETFs added $890 million. But here's the catch. Silver's total market is 15 times smaller than gold's, so that $342 million has 15 times more price impact per dollar invested. It's basic supply and demand mathematics amplified by market size differential. So what's the actual allocation strategy? Most wealth managers suggest 5 to 10% precious metals exposure total. Here's the tactical split I'm seeing work. If you go 60% gold and 40% silver within that allocation, you get gold stability plus silver's industrial upside. That means if you're allocating $10,000 to metals, you're looking at $6,000 in gold ETFs or physical, $4,000 in silver equivalents. But watch this timing element. The gold-silver ratio at 67 is still above the 50-year average of 60. When this ratio mean reverts to 60, silver outperforms by another 11% automatically, regardless of gold's absolute price. That's the arbitrage opportunity sitting in plain sight right now. If gold stays at $4,297 and the ratio drops to 60, silver hits $71 per ounce. That's $7 of upside from ratio compression alone, before any new buying pressure. The risk factor you need to know: silver's volatility runs 2.5 times higher than gold's. Those 103% yearly gains, they came with days where silver dropped 4% while gold fell 1.5%. Your position sizing needs to account for this. If you can't stomach 5% daily swings, weight more heavily toward gold. The ratio play works both directions. Final confirmation signal. Futures open interest in silver just hit 180,000 contracts. That's $18 billion in leveraged bets. When combined with the physical delivery stress in London and Fed policy tailwinds, you've got technical, fundamental, and policy alignment. This setup doesn't appear often. The last time we saw this convergence was 2020, and silver ran from $18 to $30 in 8 months. Takeaway: silver doubled gold's performance because it's an industrial commodity during an electrification boom, happening simultaneously with monetary policy that favors precious metals. The 67 to 1 ratio offers mathematical mean reversion potential. A 60-40 gold-silver split captures both the safety trade and the industrial multiplier. Just remember to size for silver's higher volatility, and you've got a position that profits whether the ratio compresses or absolute prices rise.